Welcome to the deep dive. So this week we're sifting through some sources that they tell a really strange story. It's this contrast between market anxiety and, well, serious institutional conviction. For a specific 3-month stretch not long ago, the mood in the crypto world was it was thick with panic. Bitcoin, the market leader, it slid hard.
Yeah, down by as much as 21% from its highs. Investors were really scrambling for the exits.
Yeah.
And that kind of steep drop, it usually means capitulation. Everyone is selling. But when you actually dig into the data, the transaction data from that exact period, a very unusual buyer pops up.
A buyer pouring capital in while everyone else was dumping.
Exactly.
And that's really the crux of our deep dive today. That buyer was Tether, the entity behind USDT, which is, well, it's the largest and you could argue the most crucial stablecoin out there.
And they were already sitting on a massive Bitcoin stockpile. But then they spent about $1 billion from their reserves on more Bitcoin.
They were buying the dip.
Yep.
And with serious intent.
It's more than just a purchase, though. It's like a strategic declaration. See, Tether isn't just any player. They're what we call systemically important.
Right.
So when an entity that vital makes a move like this, it forces a really profound question onto every individual investor out there.
A question for you listening right now. If Tether is this confident, does that mean you should just imitate them? Is this the signal? That is precisely our mission. We're going to go beyond that big headline number to really understand Tether's unique financial machine.
Their motivation, their structure.
And then distill the correct actionable lessons from it for your own personal investment strategy. We have to figure out why they can do this and why you probably can't just copy them. Okay, let's unpack this.
To start, I think we have to grasp the sheer scale of Tether. The reason their actions matter so much is because USDT, their stablecoin, it basically functions as the liquidity backbone for a huge chunk of the crypto trading world.
It's the closest thing the ecosystem has to, what, a central bank? A major settlement layer?
Exactly. That's what systemically important means. If Tether sneezes, the whole market catches a cold.
And the mechanism that's supposed to ensure that stability is their reserve portfolio. Their whole commitment is maintaining that dollar peg for USDT, and it's backed by a reserve fund totaling, what is it now? About $181 billion.
That portfolio is a behemoth, and understanding what's in it is key to understanding their whole strategy. Historically, they've been criticized for being a bit of a black box. A bit. But the recent filings are actually pretty clear. The vast majority of those reserves, they're held in short-term U.S. Treasuries, the gold standard of safety in the traditional finance world.
But safety doesn't mean only safe assets. We saw those figures from the end of Q3. It's roughly $135 billion in treasuries. That's the core.
Right.
But then they start mixing in other things, long-term assets. They reported holding $13 billion in gold and, most relevant for us, around $10 billion in Bitcoin.
And if you just step back and look at those numbers, Tether is operating on a scale that puts them among the largest non-government holders of both gold bullion.
An asset they've been stacking up pretty fast.
And Bitcoin. They've really crossed a threshold here from just being a crypto company to being a global institutional asset manager.
Which brings us to the financial engine that powers all this. It's not just $181 billion sitting in a vault. That money is working for them. Since they hold so much in U.S. Treasury bills and yields have been high, Tether is just immensely profitable from the interest income alone.
That is the key nugget right there. Just imagine $135 billion invested in treasuries, and let's say they're yielding 5% annually.
That's what, over $6.7 billion in revenue? Every single year.
And that's pure profit they earn just by backing their stablecoin.
So when they went and spent $1 billion on Bitcoin, they weren't risking their core reserves. The money they need for the dollar peg.
No, not at all.
They were strategically allocating a fraction of their annual profits to an investment. And that just fundamentally changes the whole risk calculation.
And what's fascinating here is the strategy behind it. I think their motivation is twofold. First, they're aiming to boost their long-term returns, fortify their reserves even more.
And second, it's a pretty brilliant way to differentiate USDT from its rivals, isn't it?
It is. Most competitors, they stick almost religiously to 100% cash and short-term bills. Safety above all else.
But Tether is building this unique structure. They're taking a modest slice of that massive profit engine and putting it into long-term, scarcity-based assets, gold and Bitcoin.
They're essentially saying our reserve isn't just safe, it's dynamically profitable.
Yeah.
So that $1 billion purchase we're talking about, it's not some one-off gamble. It's part of a very disciplined long-term strategy where they use their profits to buy when prices look good.
They saw that 21% dip as a sale.
Exactly. A chance to buy on sale knowing they have years of profit coming in to cushion any short-term bumps.
Okay, so we've established that Tether's move is incredibly savvy from their corporate perspective. But, and this is the big pivot, we have to ask you, the listener, should you just follow them? This is where it gets really interesting because the answer, when you look at the financials, it's almost certainly no.
Yeah.
Not in the same way, at least.
There is a...
But now contrast that with a household investor. If you take your emergency fund or a big chunk of your retirement portfolio, and that asset suddenly drops 50%, which Bitcoin has done before.
Multiple times.
That loss has a real, tangible, potentially catastrophic impact on your life, on your financial timeline. You are not shielded by a $6 billion profit margin.
So Tether's billion-dollar buy is a business decision. An expression of confidence, sure, but it is not a suggestion for someone living on a salary to just liquidate everything and go all in.
Their playbook is for global corporate strategy. Your playbook has to be for personal longevity.
Right.
So their how must be different, but that doesn't mean the underlying why is wrong. When you strip away Tether's unique profit stream, the core investment thesis for owning Bitcoin, it actually overlaps quite a bit.
Yes, the shared conviction there is founded on two really fundamental pillars: mathematically enforced scarcity and accelerating adoption.
This is why they're buying it alongside gold.
It's the same long-term bet you might be considering. The first driver is scarcity. Unlike fiat currency, Bitcoin has a fixed cap. Only 21 million coins will ever exist.
And no central authority can just decide to print more. That's a powerful feature in a world that's, well, grappling with inflation and debt.
And that scarcity, it's not static. It actually increases over time because of the network's design, specifically the halving program.
Yeah, we should probably define that quickly.
Good idea.
Yeah.
So approximately every 4 years, the reward that miners receive for validating transactions and creating new supply.
The new Bitcoin coming into existence.
Right. That reward gets cut exactly in half. It's mechanical.
So the rate of new supply just keeps dropping and dropping and dropping. It's a built-in constraint, completely transparent and predetermined.
And beyond that engineered scarcity, the second pillar is adoption. Bitcoin is moving from being this, fringe retail thing to something that's being integrated into the core traditional financial system. And that's crucial for its longevity.
We see that in the sources. You've got large corporate treasuries putting Bitcoin on their balance sheets. MicroStrategy is the classic example.
Sure.
That validates it as more than just a speculative trade. Then you have the massive growth of ETFs, making it accessible to millions of people in their normal retirement accounts.
And if you look even further ahead, the idea of Bitcoin being considered for sovereign reserves, for national reserves held by governments, that signals the world is viewing this as a potential alternative store of value.
Not just a digital curiosity.
Exactly. The moment big institutions start seeing Bitcoin as a necessary tool for diversification, it just fundamentally shifts the perception of its long-term viability.
So the shared bet is clear. Whether you're Tether or an individual, you're betting that adoption and scarcity will keep increasing over the next decade.
Even if you know you have to endure some stomach-churning volatility along the way.
A lot of it.
Which brings us to the critical final step, the tactical playbook for you, the learner. If you believe in this shared long-term thesis, your execution has to be completely different from Tether's big lump sum buy.
Your approach has to be steady, sensible. The first and most important recommendation is to spread your purchases out over time.
You just can't afford to try and time the market bottoms perfectly. So instead of one huge buy, you should use dollar cost averaging. DCA.
Right.
DCA just means you set a fixed amount of money, could be $50, could be $500, and you buy on a regular schedule every Friday, every month, whatever, regardless of the price.
It takes the emotion out of it. And it ensures you buy at different price points, which really reduces the risk of buying everything at one unlucky peak.
Exactly. Second, you have to commit mentally to holding for years, not months. The sources all emphasize a decade-long view.
Tether isn't going to sell because the price dipped this quarter.
And you absolutely shouldn't either. You have to see this as capital you will not touch for a very long time.
Which leads to the psychological part. You have to.
Yeah.
Well, you have to steel yourself for big declines without panic selling. We just saw a 21% slide. It's been 50% or more in the past.
And if you find yourself checking your portfolio every day and debating whether to sell because it's down, you've probably either invested too much.
Or this just isn't the right asset class for your stress level.
Right. If you get seasick, you don't take a tiny boat across the Atlantic. Volatility is the price of admission here. You have to treat those red days like turbulence on a long flight. Uncomfortable, but part of the journey.
And finally, the cornerstone. Keep the investment modest. This is crucial. This allocation belongs in the riskier, smaller slice of your overall portfolio.
A common recommendation from advisors for assets like this is often in the low single-digit percentages of your total wealth.
So Tether's move is a powerful long-term vote of confidence. But the right way for you to follow suit is not through big, risky bets. It's through methodical consistency and temperance.
So what does this all mean? The lesson is that Tether's ability to buy the dip is powered by its massive profits from ultra-safe U.S. Treasuries. They have a safety net you just don't have.
But the underlying reasons for their investment, scarcity, and adoption are entirely sound for a patient, long-term investor. You just don't have their profit engine, so your tactics have to prioritize prudence.
And as we close out, there's a really fascinating implication here. Tether is using profits from traditional, safe, fiat assets
U.S. Treasuries.
to strategically hoard both the oldest scarcity asset, physical gold, and the newest scarcity asset, Bitcoin.
Right. This systematic accumulation of both by an entity that bridges the old and new financial worlds. It raises a really pivotal question for you to think about. If even stablecoin giants are betting on this non-traditional blend of digital scarcity and physical metal, how will future corporate and maybe even sovereign global reserves be defined? It really challenges the traditional definition of what a safe reserve asset even is.